you for joining us this morning for the August City Efficiency Leadership Council webinar. Today we're going to be talking about financing of public building retrofits. Really excited about this presentation today. My co-presenter and I, Charlie and I, have given this presentation or close to this presentation before. And as many of you may know, I'm not usually the presenter on these things, but I felt like Charlie and I put together some really helpful and useful information. So wanted to go ahead and share that with the Texas audience as well. So with that, we'll jump in. Usual announcements. So next week on Tuesday, we have our final City Efficiency Leadership Council Roundtable. This is the Central Texas meeting. And we're going to talk about the San Antonio Water System Biogas Project. And later on in the presentation, we'll talk about a public-private partnership, or P3. This is an example of a P3. These meetings, as opposed to the webinars, the roundtables are for only public sector folks, and hope to see anyone statewide, not just Central Texas folks, join for that conversation. Also next week, we will have a meeting of the Texas chapter of the Energy Services Coalition. One of the other topics we're going to talk about today is energy savings performance contracting, and ESC is an industry organization focused on ESPCs, and in our chapter meeting, we're going to have some breakout sessions where we're going to talk about kind of implications to the industry for COVID, some other conversations about energy as a service. So it should be a pretty interactive meeting, and if you're interested in learning more about ESPCs, it's a good organization to participate in. You don't have to be a member to come to the meeting. You can listen in, you can participate. So all of this information will be passed on after today's meeting. I also wanted to loop back on the action cities can take to support energy efficiency in Texas campaign. This is a series of blog posts and presentations that I've put together as kind of a menu of options around what cities can do to support energy efficiency in Texas, just as it's written there. I'll link to the blog post. It's coming to an end, and we're going to wrap those up this month. So if you want to explore, they're pretty brief posts, and I think some pretty good information in there. SPEER is now offering our building operator certification training online, and this is a really great comprehensive training for specifically for building operation for efficiency and water, energy and water efficiency. Today's course is going to offer ICC CEUs, as well as I'm going to send certificates of participation for any general CEUs that folks on the call have. This is if you have self-reported hours for something. If you want the ICC CEUs, you must fill out the survey that I will send out after today's meeting. If you have any other comments or announcements, please put those in the chat box. Also, let's use the chat box for questions, but I'll make sure and grab any questions from Q&A or the chat. We'll do questions at the end, but please put them in as we're going through the presentation today. Okay, with that, jump into the agenda. So today, Charlie and I will kind of go back and forth, but we'll talk about sort of what criteria to consider when selecting a financing mechanism, what might influence financing for your organization. Kind of briefly go through types of energy efficiency projects and project delivery methods and how they kind of align with certain financing. Then we'll do kind of a deeper dive into an array of financing options, and then a few takeaways at the end. Charlie's lawyer said we had to include this, so make sure and read it when I send this presentation out after the fact. And Most of you know me, but I'm Cassidy Ellis, Local Governments Program Manager at SPEER, and I run the City Efficiency Leadership Council. And my co-presenter today is Charlie Zitnik with DA Davidson Companies. Charlie is really the expert on today's call. He has been working with public entities around financing their energy and infrastructure projects for many, many years. And as you'll hear later in the presentation, he has a very deep knowledge of the options out there for you. Charlie, thanks for being here today.
Glad to be here. Thank you, Cassidy.
All right. So with that, how do you pick your financing options? Really, the appropriate financing method for your project is dependent on many interconnected factors. And there may not be one single option that is ideal or perfectly suited. Your project size and project type may lean towards a particular method. Your city's financial profile, how much debt they have or how much debt they want to take out, or their approach. And when I say city throughout this presentation, also know this applies to school districts, this applies to counties, state agencies, etc. Your organization may have specific goals or priorities that you're pursuing around, maybe you have climate goals, maybe you have budget goals that are specific to how you're approaching your financing method. And then all of us are operating in the Texas regulatory market. There are Texas-specific rules, some of which we'll go into, but also your city, school district organization may have specific policies around how you procure projects and how you finance projects. So you do have to consider all of these fairly complicating factors, and the key is to make sure and engage and involve your finance departments and finance professionals as early and as thoroughly as possible in the process, because your CFO can be your biggest friend and your biggest source of resources in this process, and they can also be the reason that a certain project does not progress because the financing is not available. Briefly, I think most of you folks know this, but just to level set on what we're talking about today, there's kind of categories of energy efficiency projects, starting with kind of smaller, high return projects called low-hanging fruit, through to more capital intensive projects. This is when you're actually replacing equipment and full systems, into deep energy retrofits where you're talking about a full building renovation, a deep gut where you're really trying to achieve deep energy savings. And then there are other categories of energy projects like infrastructure, where you're replacing either infrastructure components for energy and water savings or as a revenue generating source. So something like a smart metering or advanced metering project. And then of course there are other energy projects like renewables and CHP, where you may have other reasons besides efficiency to pursue those. But of course, finance and paying for them is always going to be a part of the conversation. Also wanted to sort of clarify the range of project delivery methods. So your different efficiency goals can be pursued. You can get them installed through a number of different means. And certain financing options are better or worse aligned to these project delivery methods. So for instance, you may have a small project and you may have internal capacity, so you self-perform a project. When you self-perform a project, you have a great level, you have entire control internally. You're managing that project internally, either your construction management or facility managers are managing it. But of course, as a result, there's a significant amount of risk internally. If something goes wrong, if costs go over, if something breaks, you're responsible for it. As we move across the spectrum, we get into categories where you're involving outside engineering firms and design firms and having someone else build it for you in a design bid build context. And then in the middle, we have design build, where you're partnering with kind of a fully a turnkey provider, where they design and build the project for you and deliver it completely. And then one thing I want to really point out, we have energy savings performance contract here as a project delivery method. It's often considered a financing method, but really, as we'll see, ESPCs can be financed a number of different ways. So we really consider it a project delivery method rather than a finance method. And then finally, kind of on the side of where you're really turning over control and risk and management to a third party is the public-private partnership, or P3. And this is something like energy as a service, efficiency as a service, where a third party not only designs and builds, but also owns or operates and potentially even owns your asset, and the city is just paying for the service or the output of that asset. Okay, I'm seeing that we are maybe having a black box blocking the text. I think that's probably because I have the chat box open. Is that better?
Yes.
Yes. All right. Sorry, guys. I don't know what Zoom does, but hopefully that's clear. And of course, these slides will be shared with you if you missed any of the previous information. Okay. So transitioning to the actual topic today, finance. Similarly, we can kind of put financing options on a spectrum. And today we've lumped financing into three primary categories. The reality is that there are infinite iterations of, you could delve into little niche and minutia, especially in the debt finance category. But Charlie and I really wanted to try and simplify it into three general categories. So on the left, again, internal funding. This is where you're putting up capital from your internal operating budget, and there is an opportunity cost of capital, meaning that you're putting that money into paying for the project, and so that money therefore cannot be used to pay for other things in your city. In the middle, we have kind of the big category of debt finance. This is pretty traditional, where you're partnering with a lender. You're probably bringing some upfront capital to the table, and there is a cost of capital, meaning there's an interest rate charged on borrowing that money. And then over on the right, again, the public-private partnership. This is where you may not bring any money to the table. You may, because you're buying the service. There are also P3s where you're actually paid by the vendor up front. So you may actually receive money at the beginning because you're essentially giving them control of the asset, and so they're paying you for it. But the flip side is that you have an ongoing payment or sort of a subscription model where you have to pay that for that service on an ongoing basis. Accounting-wise, one potential upshot of the P3 is that it is off your balance sheet, meaning it's not an asset, but it's also not a debt you're carrying. Okay, I'm going to go through the internal funding portion. I'm going to turn it over to Charlie for debt, and then I'll rejoin you at the end. So internal funding, this, as I said, is exactly as it sounds, and it's really a reactive mechanism, or it's often, I should say, a reactive mechanism of funding. It's pay as you break, pay as it breaks, meaning your chiller goes out, you have to get it done. You don't have enough time to get a bond. You don't have enough time to get debt, so you just have to pay for it. But as internal funding mechanisms sort of mature down the value chain, you get into more intentional internal funding. You have allocated operating or capital budget during your budgeting season, or maybe you have an annual allocation through a capital investment fund, where it's a standard line item and that goes into a fund that pays for efficiency upgrades. And then And then kind of the next level of maturity is a revolving fund. And this is where you have a core set of money that you use to pay for efficiency projects that have a high enough return in terms of savings that the money comes back into the fund to perpetually fund new projects. Typically, internal funding is used for either in this reactive way or for kind of lower hanging fruit or smaller retrofits. But we've seen a couple of cases of internal funding really being preferred because there are specific goals for the city and they want greater control. So they don't, they want to do a really deep carbon neutral retrofit, and a debt arrangement doesn't provide them enough flexibility to do that. So they go ahead and find it in their budget to pay for it. It's great for when you have the money, of course, but it's also sometimes used if your financial profile of your city or organization does not allow for additional debt to be incurred. Really great example of this is right here in Texas, San Antonio's Revolving Fund. Many of you know about this fund already, but just checking, yep. Just checking the chat to make sure I'm catching everything. So San Antonio's Revolving Fund was established in 2011 with the 2009 ARA grant. Of course, seed funding is one of the most difficult parts of establishing a revolving fund, but they have kept it going, and typically it's used for funding kind of low cost, low hanging fruit projects, and sometimes for the marginal cost of a project. So their capital fund will pay for a code level efficiency chiller, and then the city's revolving fund will pay for the difference to get a higher efficiency chiller. Golda down San Antonio is a great resource, and if anyone has any questions about this arrangement, I'm happy to put you in touch with her. Okay, with that, I'm going to turn it over to Charlie to get into the meat of the debt financing stuff.
Thanks, Cassidy. I think we're going to take this from I guess a ease of entry and common usage down to maybe less common and more challenging. And Texas, as a state and by legislation, has a vast number of finance vehicles available for cities, counties, and districts. And this list you have in front of you that we refer to as debt financing, we also call this the Texas Toolbox. And that is that these are the major buckets and major categories of options available to municipalities and political subdivisions in the state of Texas. The list we're going to start with is going to be master lease agreements, and these are and Cassie, you advance on that slide. Thank you. Master lease agreements are used by larger communities, larger counties, and larger districts, and probably the proper way to envision them. They are a shelf registration or a on-the-shelf loan agreement between a particular institution and a particular political subdivision. And what it allows for is the political subdivision to, when it needs to take advantage of, when it needs to do a project, that it can take advantage of, in effect, a line of credit. And rather than having to go to the market or go to the bank for each and every individual thing that a city is going to, or a political subdivision is going to debt finance, they can simply draw down on their master lease agreement, and that will take care of funding of the asset or the project. And it's typically, as you might imagine, they're for smaller projects that ultimately can be bundled into a larger financing, and the larger financing would be used to pay off that master lease agreement. And so I think the proper way to envision it is it is a revolving line of credit. You'll be drawing from it on occasion, and you'll be repaying to it on occasion as you have critical mass on project size to justify going to the capital markets for financing. And as you can see, we've listed out some uses there. You know, that it's typically for smaller projects, because a larger project you would go to the capital market anyway. Typically shorter term in nature on the asset being financed itself, and that's typically because a master lease agreement also is limited in term and limited in scope. The master lease agreement has negotiated terms between the lender and the borrower, and typically the lease agreement itself has a sunset of something in the range of 10 years. As you might imagine, it lends itself well to equipment as collateral as opposed to real property as collateral. Just difference being equipment is generally financed with a lien or a UCC filing. Real property, buildings, etc., are financed with a more complicated security instrument. So the takeaway on the master lease agreement is to envision it as a revolving line of credit. You bundle projects under a master lease agreement, and then ultimately those projects are taken out with long-term financing. Time warrants, when we're talking about the Texas toolbox and the number of tools available to political subdivisions in Texas, this is one. This is not available in all states. This is not completely unique to Texas, but there are few states that have such a thing as time warrants. And time warrants are, the simplicity of a time warrant is that it doesn't require voter approval. It doesn't require an attorney general opinion. And then, so those are the easy parts. And then the use of it is you don't go any longer than 15 years. You can't do a project in excess of $1 million. And that's not to say you can't have multiple time warrants outstanding. It's just each project you finance can't be more than $1 million. And then, much like the master lease agreement, if a community or a municipality doesn't have a master lease agreement because they are not frequent assessors of the capital markets, then a time warrant seems to make good sense as a alternate tool. Somewhat like the master lease agreement, you know, it's the projects are typically smaller in nature, and it's typically, but not always, used for equipment as opposed to real property. This term, lease purchase agreement, annual appropriation debt, certificates of participation, they all fall under an umbrella of its lease financing that is subject to annual appropriation. And this can be structured as equipment or as real property, somewhat dependent on the political subdivision. It doesn't count against indebtedness. It's not considered in the legal sense debt, meaning that in each budget year, the governing body has the ability to not make the appropriation, okay? So unlike a bond or debt, where it's contractually obligated to make the payment for the life of the financing, the theory behind a lease purchase agreement or annual appropriation debt, excuse me, is that in each budget year, a overt decision needs to be made to appropriate funds to make the payment on that asset. And this, you'll see this frequently used with energy savings performance contract financing, and keeping in mind that an ESPC in and of itself is not a financing. ESPCs are a procurement tool. Underlying that ESPC is a finance structure. So just to make the distinction, ESPCs are procurement tools, not finance tools. ESPCs typically need to be financed. Maintenance tax notes, not terribly frequently used, somewhat limited in scope, because the theory is you issue maintenance tax notes to raise capital to do maintenance. And if you think about that, that's a bit of an oxymoron. If you're maintaining the asset, then you don't need to raise capital because the asset is being maintained. The reality is that governance is such that typically projects aren't maintained to a level that doesn't require at some point raising capital to upgrade or repair or replace the asset. So this is a tool that's allowed in Texas to raise capital to maintain an asset. And we put maintenance expenditure in quotations because it's not a defined term. And I think a competent legal counsel would interpret it in a variety of ways. And that's why they would call the counsel's opinion just that, an opinion, not a fact. So there are a variety of ways to define a maintenance expenditure, going from simply doing maintenance to replacing the asset, because the asset has worn to the point that it requires replacement. And all of those, depending on what the use is, could be considered a maintenance expenditure. Not necessarily unique to Texas, but we typically see issues under maintenance tax notes being done for shorter term, although the legislation allows for it to go out to or up to 20 years. Another somewhat unique tool in Texas, the certificates of obligation. These are loans that are secured by operating revenue, or excuse me, operating tax or maintenance maintenance levies. They're payable, although they're secured by that, they're payable from all legally available funds. So if you, for instance, have a sales tax fund, general sales tax fund, a certificate of obligation can be paid from those funds. So the term all legally available funds is a bit of a catch-all, for it's not limited to being paid by a debt levy or operating tax or a maintenance levy. And these are typically very quick in nature, meaning getting them out to the market and getting funded. And as Cassidy, I think, pointed out early on, this is a tool that's used when you have often used when you have a catastrophic emergency and need immediate funding. It's also used in a longer term sense on occasion for the financing of performance contracts, but typically it is for immediate funding of a catastrophic event. And you know, as you can tell with this presentation, we've tried to gather in several buckets all of the tools available to political subdivisions in Texas. And in trying to restrict the number of slides we have, I guess I would say, you know, never underestimate the creativity of an investment banker. all of these tools we're talking about are used individually and in conjunction with each other, and you may have derivations of each of those. So under that umbrella, we've also just done somewhat of a screen grab on bonding, traditional bonding. And in the realm of traditional bonding, we have general obligation bonds and a revenue pledge bond. And to give you the high level distinction, a general obligation bond is typically requiring a public vote and approval, and the bond is then paid, the general obligation bond is then paid by a debt levy on property within the boundaries of the taxing district. So it's a pledge of tax revenue to make the debt payment. Switch over, still a bond, but a revenue pledge bond. This is something more of a financing for what we would consider a business enterprise, or more traditional water, sewer, gas, those kind of services provided by a political subdivision. And the pledge on a revenue bond, unlike a general obligation bond that has a tax pledge, a revenue pledge is a pledge of the revenue from the enterprise, meaning the rate charged on the enterprise to the customer will be such that the revenue will be sufficient after the operation and maintenance of the enterprise to pay the debt service for the bonds on the enterprise. And we see this in the scope of performance contracting. We typically see this on larger projects because of the vote requirement. And we also see it on larger projects because of the costs involved of doing a general obligation bond or a revenue bond. Typically, you're trying to spread the embedded costs of actually doing the financing over as wide a financing as you can. And then finally, and this has come up on a number of presentations we've done, there is the green bond or climate bond structure, and that term is a bit misleading. There are organizations that are now being utilized to make a determination of your project being green in nature. Green bonds or climate bonds sound like they limit the analysis to strictly bonds, but that's incorrect. What's being analyzed is what the proceeds of the financing are being used for, not the structure of the financing itself. So any project that has ESG goals, regardless of whether we're doing it as a CO or an annual appropriation lease or a revenue bond or a general obligation bond, all of those instruments can satisfy ESG goals so long as the project itself is achieving ESG goals. So I guess it's the finance tool is the delivery mechanism underlying the finance structure is the project that will meet or not meet the ESG goals. And I'm gonna have Cassidy give a little bit of elaboration here on a very often utilized program for multiple political subdivisions in the state, very successful program called the LoanSTAR State Revolving Fund, a bit different than what San Antonio has. And Cassidy, you want to jump back in and Cassidy?
I thought I'd unmute. Yeah, I thought I unmuted myself.
Okay.
Many of you on the line are probably pretty familiar with LoanSTAR, and we do have a couple of CECO folks on the call who actually run LoanSTAR. So in the Q&A, if we have more specific questions, they are available to assist. But generally, CECO LoanSTAR is a fund designed specifically for energy and water savings projects. It is offered at a low interest rate. That interest rate, it's offered annually. It has been at 2% or the 1% option if you use the ARA funds, which have some more requirements, some more deeper assessment, but are offered at that lower interest rate. Generally, it has been an $8 million cap per application with 3 applications available annually. The loan availability is on the state fiscal year, which is going to end on Monday, but those loan fund availabilities are published regularly, and so I would expect one in October, but Eddie or someone from CECO can confirm. LoanSTAR is used in conjunction with ESPCs and other project delivery methods in Texas. There is a 10-year payback requirement or 15 years if it's above 50% HVAC work, since those tend to have longer payback periods. And the improvement and the debt must, the savings from the project must pay for the debt and cost of improvement. Very commonly used, and I'm sure folks on the call have had some experience with LoanSTAR. Okay, so going into the final category is our public-private partnerships. So there's a couple types of P3s that we're going to talk about. Again, there may be other versions and other iterations of P3s. These are kind of the categories that we're going to focus on. So the as-a-service energy savings contract, energy savings agreement, these go by kind of a number of different names, but it's basically, as I described earlier, an outside vendor, third party designs, builds, and operates an asset for you, and you pay for the use of that service. And as a service arrangements are sort of exploding into a lot of different iterations. So you can have something as small as lighting as a service, where your outside vendor, they install the lights, they own them, you just pay for the number of hours of light that you use, or you pay an annual or monthly cost. And it can be all the way on the other end of the spectrum with infrastructure as a service, where an outside operator is building a combined heat and power plant for you, or a chiller, and you are just buying the steam or kilowatt hours or hot water or chilled water off of that asset. Again, best for, you know, I say $2,500 or $25,000 or $250,000. That came from some Department of Energy information, but from what I understand, as a service arrangements can be any innumerable size projects. They're really for when your organization, for whatever reason, does not have the internal capacity or the expertise, or just doesn't want the responsibility and risk of running an asset. And from what I understand, we often see these in like higher ed or hospital systems at this time, although there is some uptake and growth in cities, counties, and K-12. One well-known example of a public-private partnership as a service is North Dakota University's chiller plant. So they had an outdated plant that needed considerable amount of money in repairs. They partnered with a outside energy services company to, they were really focused on making sure that they had certainty of their operations and costs and redundancy. That third party built and operates a new natural gas steam plant. They have a 40-year contract, and they are certain to have a certain cost and a certain reliability of their electricity on the campus going forward. And then finally, power purchase agreements. So these are kind of the most well-known tool used for renewable energy projects. And it's very similar to an as-a-service arrangement where you're basically using an outside party to build and operate often renewable energy generation, and then you're buying the output of it off of that array. Again, kind of longer contract terms and used for larger projects. Okay, so finally, a few takeaways from kind of the breadth of information that we've shared. Determining your finance method is dependent on a number of quantitative and qualitative metrics and factors, and you really kind of need to consider the range of options in going into a project. Engage with your stakeholders, both your end users as well as your finance professionals early and often. Debt financing is well understood and well known. It's very commonly used, and so there may be fewer barriers to entry at times, but internal financing offers greater levels of control. Of course, internal financing funding is, I'm sure, a pretty sensitive topic right now, considering prior to this year, there was already revenue caps put on a number of local entities. And then, of course, 2020 has been a challenge in every way, shape, and form, especially with city budgets. But internal funding does have a lot of benefits and value associated with it. There are a number of innovative financing structures available, but with those kind of more innovative structures, as they are being better developed, there are transaction costs, legal fees, consultants fees associated with them. P3s are available for a broad range of projects, and specialized financing, those are emerging ways to really support renewable energy and climate goals for your city. I do want to mention that a number of the other instruments that we discussed can also be used to finance renewable energy. So even though we featured power purchase agreements, you can use a lease purchase to procure or finance renewable energy, and a number of the other ways as well. Certain projects are better positioned to attract green investors. And I do want to just sort of revisit the ESG. That stands for environment, social, and governance. And basically it's shorthand for some of your lenders may have certain goals around sustainability and climate, and therefore may be willing to support financing a green bond at an advantageous rate because they want those in their portfolio. So that's kind of clarifying that. And then be open to different perspectives and don't necessarily assume that one size will fit your needs. And the advice that I got early on in working with cities around energy efficiency is the only thing that's typical is that nothing is typical. So, it takes some work and it takes some coordination, but there are great options. I also meant to say this earlier, but some of you may be noting that we did not talk about utility programs today, not because they're not rebates and incentives, not because they're not a great source of supplemental money in an efficiency project, but they vary so widely, a little bit less now that we're only talking about Texas and that we have IOU, standard offer IOU programs, but really Charlie and I saw those as supplemental funding, and it's fairly unlikely that a utility program is going to fund the entirety of your project. But just noting that we didn't completely, we are aware that we didn't talk about this today. Okay, before we jump into questions, I do want to alert you guys to what's going on past the question slide, we created a number of additional resources that just didn't really fit into the timing of today. I encourage you to go through these. We have some pros and cons of the different debt types. We have some schematics of how different structures work, and a couple case studies back here. So I encourage you to kind of look through these additional resources. And of course, Charlie and I are available to take a deeper dive into any questions associated with those. So with that, I'm going to go back to the chat and encourage you to start putting in some questions. Just noting one comment. Yeah, so new accounting rules are making it more and more, and I've heard this before, and German, feel free to elaborate, are making off-balance sheet arrangements more and more difficult. So if that is something that's a motivator for your city where you need to not have the debt on your balance sheet, it's difficult, increasingly difficult to do that, but there are some cases where you can. Okay, so definitely put in questions in the chat. You know, I think going through and putting together these presentations with Charlie, I wanted there to be an easy sort of plug and play, you know, for this type of project, you want to use this kind of financing. And I wanted it to be very sort of linear. I like putting things in buckets and making things linear. And the reality is that it's not that simple. And Charlie, I think one of the things that you and I talked about is 10 years ago, there were 3 or 4 options, right? And then now there's more and more different versions. Is that an accurate description?
It is very, very much so. And I think, you know, I think that the need to engage with whatever your internal office is of environmental quality, having that office engage on, when we had that top 10 list up, number 2 was engage with your internal finance team early and often, and engage with your external finance professionals early and often. We can all, on the Office of Environmental Quality side, come up with a beautiful project. But if we've done that in isolation and without the input and buy-in from the finance team, I wouldn't say we've wasted our time, but we may well get shot down, as opposed to having early in the process brought them in as stakeholders and very, very helpful collaborators on bringing a project to fruition.
Yeah, and I think there were a couple examples that you mentioned where a project, exactly what you're saying, a project had gotten quite far down the line, and then the real details of the financing diverted it or made it not happen. So,
right.
Charlie, I'm curious to hear from you. You know, of course, 2020 has been quite the year in many different ways. Do you have any kind of initial insights or thoughts about how COVID and city budget, and potentially going into legislative session next year, sort of how you see the world of finance being affected by recent events? Not to put you on the spot.
Well, I have zero prediction on interest rates, but I will give you what I think is a very interesting observation, that as the COVID, as the new is settling in, and you know that the reality that local governments are coming to, that we're going to be dealing with COVID for a long time, we're seeing generally speaking, across the board on projects that were in process but not funded or closed yet, we're seeing about a 15% increase in project scope for the addition of, I guess, while contractors are mobilized, local governments are saying, let's go ahead and get the indoor air quality issues taken care of. Let's get the touchless doors taken care of. Let's get the touchless bathroom fixtures taken care of. Let's do all of those things that address the new. And that seems to be, generally speaking, adding about 15% onto projects. So I don't know if that's what you were looking for, Cassidy, but that's what we're finding out there. And we're not seeing any kind of a slowdown in new projects coming out, and we're certainly not seeing projects being put on hold that were already in process.
Yeah, I think that's.
And I'd be interested to hear from others in that regard. You know, maybe with just a thumbs up, thumbs down on, you know, we are seeing the dark side, or we are seeing the upside.
Yeah, absolutely. In the chat, it would be great. Let me just double check. Yeah. If folks have seen a change, we have both folks in the public sector side as well as service providers and some ESCOs on the call today. And so if you have experience or initial insights, please put that in the chat. Yeah, you know, I think that, so in addition, do you think that in addition to adding in those additional sort of environmental and safety projects, do you think that there is any kind of move to add scope in anticipation that the next few years it's going to be challenging to get support for additional projects? Like people are just kind of getting it in under the.
We're seeing, as you said, as you described, we're seeing that particularly in K-12 right now. And yes, I think there is a concern that looking out on the horizon by the administrators, that there is concern with maybe it's getting bond levies passed, or maybe it's just the ability to undertake capital projects, that there seems to be a drive to get all we can do done currently, because we don't know what the future is going to bring.
Yeah. Uncertain times.
And we're at such a historically low interest rate environment, and I don't know anybody's got a good indicator of how long that will last, or when that will change.
Yeah. Yeah. Well, I know that everyone in the world is trying to refinance their mortgages right now, to the point where someone told me that Fannie Mae put a half-point sort of premium on refinancing right now. So, you know, it's an interesting time in the finance world, I'm sure. Yeah. Well, with that, I think we'll go ahead and wrap up, but I do want to send my well wishes to anyone on the call who is in East Texas, and stay safe. Hopefully you and your family are safe with the events of the last 24 hours. And as always, thank you so much for attending. And we will see you guys again for the next one. And as soon as I get my next webinar scheduled, I will make sure everyone knows. All right. Have a good and safe rest of your day. Take care. Bye.